In the world of investing, there's a timeless adage that resonates with both seasoned veterans and eager newcomers: buy low, sell high. It sounds simple enough, almost deceptively so. Yet, this principle underpins countless success stories in the financial markets. We're drawn to bargains in every aspect of our lives, from snagging that coveted item on sale to finding an incredible deal on a dream vacation. The inherent psychological appeal in acquiring something of value at a price that feels like a steal is undeniable. This inclination extends to the realm of investing, where the prospect of buying an asset at a discount only to witness its value soar over time is undeniably enticing. But as with most things in life, turning this principle into consistent profits requires a blend of discipline, strategy, and a keen understanding of market dynamics. We'll uncover the secrets behind this investment wisdom, providing you with the tools and knowledge to navigate the complexities of the market with confidence. So, if you're ready to unlock the potential of buying low and embark on a journey toward earning high, fasten your seatbelts and prepare to dive into the fascinating world of value investing. Buy low, sell high. This seemingly simple mantra belies a depth and sophistication that has captivated investors for generations. It's not merely a catchy phrase, it's a philosophy, a strategic approach to navigating the often turbulent waters of the financial markets. At its core, buying low is about identifying and acquiring assets that are undervalued by the market. This means looking beyond the hype, the noise, and the short-term fluctuations that often drive emotional investment decisions. It's about conducting thorough research, exercising patience, and having the conviction to invest when others are fearful. The allure of this strategy lies in its potential to generate significant returns over the long term. When you buy an asset at a discount and its intrinsic value is eventually recognized by the market, the potential for profit can be substantial. Whether you're a seasoned investor or just starting your journey, the principles of buying low and selling high remain timeless and universally applicable. In a world of ever-evolving financial instruments and market trends, this fundamental approach continues to serve as a beacon of stability and a pathway to lasting success. So let's delve into the intricacies of this powerful strategy and equip you with the knowledge to make informed and profitable investment decisions. In the ever-evolving landscape of investing, it's remarkably easy to get swept away by the siren song of hype. The financial world, much like a bustling marketplace, is often abuzz with talk of the next big thing, the stock that's guaranteed to skyrocket, the investment opportunity that promises to make you rich quick. These narratives, fueled by media frenzy, social media chatter, and the fear of missing out, can be incredibly seductive. It's tempting to jump on the bandwagon, to ride the wave of euphoria, and to believe that this time it's different. But here's the hard truth. More often than not, chasing hype leads to disappointment, if not outright financial losses. The problem with hype is that it's often built on speculation rather than solid fundamentals. When emotions run high, investors tend to overlook crucial factors such as a company's financial health, its competitive landscape, and its long-term growth prospects. Remember, investment decisions should be rooted in careful analysis and a rational assessment of risk and reward, not driven by the fear of being left behind. It's human nature to find comfort in numbers, to feel secure knowing that others are making the same choices. This herd mentality, while understandable, can be particularly perilous in the world of investing. When a particular stock or asset class becomes popular, it attracts a surge of buyers driving up the price. This can create a self-fulfilling prophecy, at least in the short term, as rising prices attract even more investors eager to capitalize on the momentum. However, this upward spiral is often unsustainable. As prices become increasingly disconnected from underlying value, a bubble forms. And as with all bubbles, eventually they burst. When the inevitable correction occurs, those who bought at inflated prices are often left holding the bag, facing significant losses. The key takeaway here is that popularity is not an indicator of value. In fact, some of the most successful investors are contrarians and seek opportunities where others see only risk or uncertainty. To truly unlock the potential of buying low, it's essential to cultivate a contrarian mindset. This doesn't mean blindly opposing popular opinion or being different just for the sake of it. Instead, it's about thinking independently, critically evaluating market trends, and being willing to invest when others are fearful. Contrarian investing requires courage, conviction, and a long-term perspective. It means looking beyond the headlines, tuning out the noise, and focusing on the fundamentals. Remember, the market is driven by emotions in the short term, but in the long run, it's logic and value that prevail. Some of the greatest investors in history, from Warren Buffett to Benjamin Graham, have attributed their success to their ability to think differently, to identify value where others see only risk, and to have the patience to let their investments mature over time. In the next section, we'll delve into the practical tools and strategies that will empower you to become a more discerning and successful investor. We'll explore how to conduct thorough research, identify undervalued assets, and make investment decisions that align with your financial goals and risk tolerance. Now, let's delve into the practical tools and strategies that can guide you toward those hidden gems in the market. When we talk about buying low, it's not about simply finding the cheapest stocks out there. It's about identifying undervalued assets, companies whose true worth is not yet reflected in their current market price. This is where research becomes our most valuable tool. It comes in two primary flavors: quantitative and qualitative. Quantitative analysis is like looking under the hood of a car. We dig into the numbers, examining financial statements, crunching ratios, and evaluating the company's historical and current performance. We're looking for indicators like strong earnings, growth, healthy profit margins, and low debt levels, all signs of a financially sound business. Think of it like detective work, piecing together clues to determine if a company is truly undervalued. Don't be intimidated by the jargon or the spreadsheets. There are plenty of resources available to help you understand the basics of financial analysis. Or you can always consult with a financial advisor to guide you through the process. While quantitative analysis provides a crucial framework for evaluating investment opportunities, it's only part of the story. Qualitative analysis delves into the less tangible aspects of a business, like the quality of its management team, its competitive landscape, and the long-term growth potential of its industry. This is where we go beyond the numbers and try to understand the company's story, its competitive advantages, and its ability to adapt to changing market dynamics. For example, a company with strong brand reputation, a loyal customer base, and a history of innovation is generally better positioned for long-term success, even if its financials are going through a temporary rough patch. Reading industry reports, understanding market trends, and even observing a company's customer service and marketing efforts can provide valuable insights that aren't always reflected in its balance sheet. Remember, we're not just buying stocks. We're investing in businesses. And understanding the qualitative aspects of a business is essential for making informed decisions. Quantitative and qualitative research are not mutually exclusive. In fact, the most successful investors understand the power of combining these approaches to gain a comprehensive understanding of an investment opportunity. Think of it like this. Quantitative analysis provides the foundation, the hard data points that tell us if a company is financially sound. Qualitative analysis adds the context, the nuanced understanding of the company's story, its industry, and its future prospects. It's in the convergence of these two approaches that we often find the most compelling investment opportunities. By carefully considering both the numbers and the narrative, we can make more informed decisions, identifying companies that aren't only undervalued by the market, but also poised for long-term growth. This holistic approach to research helps us minimize risk and maximize our chances of finding those hidden gems that can supercharge our investment portfolios. Now, let's talk about a fascinating aspect of analyzing a company's potential insider ownership. This refers to the percentage of a company's shares that are held by its own executives and directors. Think of it as a measure of skin in the game. When insiders, those who know the company best, are heavily invested, it often signals their confidence in the company's future. Conversely, low insider ownership can raise red flags. It might suggest that even those closest to the operations are not convinced of its long-term prospects. Keep in mind that insider ownership is just one piece of the puzzle. It's not a foolproof indicator on its own. However, when combined with other research, it can offer valuable insights into the motivations and beliefs of those running the show. Websites and financial platforms readily provide information on insider transactions. You can see if they've been buying or selling their own company's stock. Remember, insider buying is often seen as a positive sign, indicating optimism, while insider selling can be interpreted in various ways, so it's essential to consider the context. Moving beyond ownership, let's talk about another crucial aspect of identifying a good investment: profitability. Specifically, we want to focus on profit margins, a key metric that reveals how much profit a company generates for every dollar of revenue it brings in. High profit margins are generally a sign of a healthy and efficient business. It means the company is effectively managing its costs and pricing its products or services competitively. when analyzing a company's profit margins, it's crucial to compare them to others in the same industry. A company with significantly lower margins than its peers might be facing internal challenges such as poor cost control or an inability to compete effectively on price. On the other hand, consistently high margins can indicate a strong competitive advantage, brand loyalty, or efficient operations, all desirable traits in a potential investment. The holy grail of buying low lies in uncovering undervalued assets. These are companies whose true worth is not yet reflected in their current market price. Imagine finding a rare antique at a flea market, knowing it's worth far more than its sticker price. That's the essence of spotting an undervalued asset in the stock market. Now, finding these hidden gems requires a mix of art and science. It involves digging deeper into financial statements, understanding market trends, and evaluating a company's long-term growth potential. One classic approach is to look for companies with a low price to earnings (PE) ratio relative to their industry peers. This ratio compares the company's stock price to its earnings per share, essentially telling you how much you're paying for each dollar of profit. A lower PE ratio, especially when compared to similar companies, could suggest that the market is undervaluing the stock. As we've journeyed through the world of buying low, we've encountered crucial insights. Remember, successful investing is a marathon, not a sprint. It requires patience, discipline, and the ability to resist the allure of quick riches. When you identify an undervalued asset that aligns with your investment goals, be prepared to hold it for the long haul. The market may not recognize its true value overnight, and short-term fluctuations are inevitable. However, by focusing on the fundamentals, trusting your research, and staying the course, you increase your chances of reaping the rewards of your patience. Remember, even the most successful investors experience setbacks along the way. It's how you learn, adapt, and stay committed to your investment strategy that ultimately determines your long-term success. As we conclude our exploration of unlocking investment secrets, buy low, earn high. It's time to step back and appreciate the enduring power of this investment philosophy. Throughout this journey, we've delved into the pitfalls of chasing hype, the importance of thorough research, and the art of identifying undervalued assets. Remember, buying low is not about timing the market perfectly or trying to predict short-term fluctuations. It's about adopting a disciplined and patient approach, focusing on the fundamentals of a business and trusting that over time, the market will recognize true value. When you invest in companies with solid financials, strong management teams, and a clear competitive advantage, you're essentially planting seeds for future growth. Just like a well-tended garden, your investment portfolio requires nurturing, occasional pruning, and the patience to allow your investments to flourish. Embrace the long-term perspective and remember that the most rewarding returns often come to those who resist the urge to chase quick profits and instead focus on building a portfolio of quality assets. In the world of investing, there are no shortcuts, no guarantees, and no crystal balls. However, by arming yourself with knowledge, developing a sound investment strategy, and cultivating the discipline to stick to your plan, you'll be well equipped to navigate the complexities of the market. Remember, every investor's journey is unique. Your risk tolerance, financial goals, and investment timeline will shape your decisions. Don't be afraid to seek guidance from experienced financial advisors. Continue learning and refining your investment approach and never stop asking questions. The pursuit of financial well-being is an ongoing process. Embrace the journey, learn from your experiences, and celebrate your successes along the way. Here's to making smart investment choices and unlocking your full financial potential. Thanks for watching.